Hi, everyone. Welcome to the Timing Research Show for December 28th, 2015. Today we will be talking about the 118th weekly report from Timing Research. So if you haven't had a chance to take a look at that yet, just go to TimingResearch.com/reports, and you can download that or any past report there. My name is David Kosmeter, and I'm the creator of Timing Research, and I have Dave Landry here hosting for me again. So I go ahead and turn it over to him.
Thank you, Dave Kosmeter, and thanks to Timing Research for having me back to host once again. Let's go to you, Gary Dean of SentimentTrader.com. Tell us a little bit about your trading and tell us a little bit about SentimentTrader.com.
Well, basically, what we do. How you doing today?
Doing great, man. Good to see you.
We're basically. I run it with a well-known market timer called Woody Dorsey. He's been in the business for over, I think, 40 years, but he's a big behavioral trading type analyst, and he bases it on. He has a sentiment data that he's been running with the same really group of investors and investment houses and stuff for over 30 years on it. So the way that what we really do with our newsletter is he has a bunch of timing profiles that they usually what they're doing is projecting when to expect volatility. So if the market's moving down, we have specific dates that are then looking for when the market is going to turn back up again, and vice versa if it's going up and moving down. And really the way the whole newsletter fits together is we use the technical timing indicators that forecast when to expect the market to turn. And then from there, we match that up with his sentiment data that he compiles every day. And if we're looking for a reversal from the upside, if it's high sentiment that's backing the turn date, we then go off of just regular technicals to confirm it again to figure out, are we getting bearish divergences? Are we in some kind of resistance zone? And again, vice versa. If we're looking for a bottom, then we're just looking for low sentiment, and it's really the way it is. It's a swing trading type thing. We're not in and out of trades in a day or two. They're usually lasting anywhere from 7 days all the way up to a month on certain time periods, and that's really the information that we relay to people. It's a combination of time, sentiment, and as well as just regular technicals to figure out where these turns would be.
Cool. Neat stuff. All right, Michael Filighera of LogicalSignals.com, veteran of the show. Good to see you back again, Michael. Tell us a little bit about your trading for those of us who don't know you, and then tell us a little bit about LogicalSignals.com.
Okay. Good to be back. Good to see you, Dave. LogicalSignals.com is basically my website that I set up because many people were asking to have continued analysis and just to kind of get in on some of the things that I was doing. So I started Logical Signals. I started to write more frequently, and out of that came the Logical Signals Trade Room, because then everybody wanted to be able to participate and do the different types of trades that I've been putting on. The basic methodology that I use is that I have switched from being a position trader and to being a day trader, and continue to focus on volatility, but use it more in just in the futures, so price volatility. And I have written about 3 or 4 algorithms, and that we run every day, and that's what generates our buy and sell signals for us. And we are definitely not long-term traders. We are minute by minute, second by second traders, almost, just depending on how the markets are trading or reacting at that particular time. And what I've just done, or what we're now working out, is an additional algorithm that we're throwing on top of everything, which is going to it's an auto trader functionality.
Cool.
And so it just we're kind of working out the settings and getting out the bugs and making sure that it all goes well, so that when everybody's back from holiday, it'll be ready and to go.
Cool. Most of your algorithms are mean reversion, or what type of trading are you doing with those?
They're basically, a lot of them are yes, mean reversion, and they're more based on momentum.
Cool.
So, and that's what we're attempting to do. So it's like, it takes a lot of different factors in, and one of them is momentum, and the other is stochastic and things of that nature.
Cool. All right, AJ. Looks like AJ is fresh from the witness protection program. I didn't recognize you there. I got a little something's going on there. I can't figure out what it is, but something's different. AJ, tell us a little bit about yourself, and tell us a little bit about. It looks like a boy went away and came back a man.
Yeah.
Two different people.
It's my winter look.
With AJ. Tell us a little bit about yourself. For those of us who don't know you, tell us a little bit about TradingTrader.com.
Hi, everybody. This is AJ, and thanks for having me back. Yes, I've got my winter look on. This is what I do in the winter, even though it's a balmy 75 degrees here. With Trading Trainer, I founded this company along with its sister nonprofit, where we take inner city kids and train them on trading and all other kinds of financial competency aspects since 2003. Our focus is not just equities, but equity options. I'm probably somebody, I like to coin myself as a lazy trader. I'm all about low-hanging fruit. I'm all about pattern recognition, so trading the correct option strategies to match what the market's telling you to trade right then and there, not to force a strategy on the market. I don't know what else to say except for we've been very successful for the last 12 years in our endeavors, so we're going on.
Cool. All right, Dean. I see you waiting patiently over there. Last but certainly not least is Dean Jenkins from FollowMeTrades.com. Dean, tell us a little bit about yourself, to those of us who don't know you, obviously, and then a little bit about FollowMeTrades.com.
Yeah, you bet. And thanks for having me back. I was here one time before, so this is my second time.
Yeah, I recognize you.
Yeah,
I remember.
Good to be back. Yeah, I hesitate to make a forecast this time because it was true last time. I don't want to break my winning streak, you know.
Oh, I got you.
Yeah, so I'm Dean Jenkins, founder of FollowMeTrades.com, and I offer education, one-on-one coaching, and then I have a stock picking service. I position trade, so I went from day trading to position trading. I found I just didn't have the temperament to spend that many hours in front of the screen. I like that term that AJ used, maybe kind of a lazy trader, right? I like to put the positions on and then go for a walk, go take a nap,
Yeah.
come back and see how they're doing. So I position trade stocks, ETFs with options, and then I publish my picks to my subscribers, and I offer an options course and one-on-one coaching and just training to be a trader. So I use primarily a simple version of Dow theory, a simple version of Elliott wave theory, and the applied reality trading software from Traders Coach. And keep it really simple. Try to get in on impulsive trends. Get an option if there's a good market, you know, for the equity I'm trading, good options market. And I'm in 4 to 6 weeks is the average trade. Just try and catch an impulsive move and take the profit and move on.
Cool. Yeah, you know, that day trade thing. Michael could do it over there, but he's cut from a different mold. I used to have a bucket under my desk for a while, and I realized that just in case with a little Lysol in it, because I couldn't leave my screen. And then one day I realized I didn't want to be found dead that way, as I wrote a column a while back. So yeah, it's still nice to have a life. You know, get out and take a walk every now and then. But I think Michael's you came from the floor, Michael. So I guess you're more in tune with that type of lifestyle. So good for you. Anyway. Dave Landry from DaveLandry.com. I believe you can only predict the short term when it comes to markets. However, I think the real money's in the longer term trading. So what I like to do is predict the short term and hopefully stick around longer term and catch a longer term move with a portion of the position. I have a hybrid approach to money and position management, which allows me to do this. And you can find that on my website, DaveLandry.com, under products, and there's a free report section with free reports on that and quite a few other things. Okay, let's go back to you, Gary. Tell us a little bit. Sorry, we already did that. Question number 2 is, based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower from today to, I guess, Thursday's close? And then, based on that prediction, rate your confidence to that prediction by estimating the probability that you have correctly predicted this week's market move.
Well, we're actually looking for some weakness to go into around the January 5th time period, but it's the tough question on what it's going to be from here to Thursday is are we going to get these jumps back and forth and even, you know, I'm not really expecting a whole lot this week just because of it's going to be some light volume. Some weakness was anticipated. We're seeing that today. But to me personally, I think it's going to be, it could be down a little bit to flat. No monster moves either way. But if any surprises would be, most likely I would be looking for it to be to the downside. And that's really just because we had a 91% sentiment reading on Wednesday, which, you know, we report those on Thursday, and we were really looking for strength to head into the 24th, which is come and gone. We got that. So we're looking, I'm expecting lower. How much lower this week? It's going to be, you know, we may see a majority of it right today and now just chop around into Thursday and maybe end down a little bit. And
yeah, thin and choppy for this week is usually the modus operandi. So you said slightly down bias, and then what was your
confidence?
Correct.
Yeah, my confidence level. I mean, I'd give it 50%. Like I said, it's really difficult when you have volume that's going to be light heading into the end of the year. So I would give it a 50-50 shot on it. I wouldn't be making any big bets with either side. Even though I do think that the bias will be a little bit to the downside, but we could get these big moves with the low volume.
Yeah, amen. Michael, same question to you.
I am tending to agree with what's already been said. I think that the Christmas rally or the Santa rally may already have occurred. Now, normally, I would anticipate that it would follow through this week as traders and managers and everybody start to get ready for year end. But I don't think that that's going to be the case. I see them, you know, kind of pushing things up right now, but it's just all being controlled by big players moving in, either, you know, they're buying baskets of stock, and I don't know what they're doing against it, but I would anticipate that it's going to be lower. And my confidence level is probably 75.
75. You cut out for a second. It sounded like you were alluding to the fact that they might try to paint the tape.
Yeah, they are trying to paint the tape now,
Gotcha.
but I don't know how successful they're going to be. But yeah, that's what I see happening. But I don't think that, you know, the major push to have a higher close for year end, I think that's over. So I think that kind of went out with Friday, or actually Thursday's weekly.
Yeah, that's an interesting point. It looks like they tried and didn't succeed, so they just kind of give up a little in here. Interesting. Yeah. All right, AJ, you're a veteran of the show, so I'm not going to repeat the question for you. Go ahead. Same bat question, same bat channel.
I'm going to take the opposite. I think first I'm going to agree with the few voices speaking loudly, as I like to say. So there's not that much volume, so you're going to maybe see some price action, lots of chop. But as soon as the volume comes back, that's going to be the real sentiment of where we're going to go. So in the meantime, I'm going to take the opposite and say that it is going to go a little bit higher. I do think that they're doing, you know, as you say, painting the tape, and I think that they're going to have a little bit more action on that. And I think that the Santa Claus rally will kick in, not today, but probably the rest of the Tuesday, Wednesday, and Thursday. So I'm going to say a little bit higher, but again, I'm going to say as soon as the volume is back, that's going to be the real story next week. And I'm going to say with a confidence of about 60%.
60%. All right. Okay, Dean, do you need me to repeat the question, or you think you got it?
I think I got it. Can I go ahead and put
All
a
right.
chart up? Is that cool?
Well, we're going to do that in the next segment. So
Next
just
segment. So
yeah,
now
hold
just,
tight. We'd love to see
yeah.
the charts and all. In fact, I would encourage everybody now to get their charts ready because on the next question we want to pull the charts up. So just give us the up or down and your percent correct, percent confidence, and then we'll. In fact, let's do that. Go ahead and bring your charts up. Let me just shift gears here, and then we'll wipe out the next question at the same time. So bring your charts up, and while you're doing that, let me read the next question. What developing events that can be technical or fundamental will you be watching out for during this week that might have a positive, negative impact on the S&P 500 and other U.S. markets? Okay. Was that too confusing?
Okay, I can answer both questions at once if you want.
Okay, and then you can hit share for your charts now. So that's usually on the next question, but I went ahead and combined everything. So go ahead and pull your charts up.
There we go. There we go. See that all right? Am I sharing that?
Now, I think you have to hit like one extra share button. You hit share, then you have to like share again.
I'm
Yeah.
seeing it.
I'm seeing it.
Okay, good.
Looks
Yeah.
fine.
Okay, so I'm agreeing with the sentiment that we're primarily going to have just chop and some back and forth this week. You know, with the short week, the holiday, end of year, low volume, all that stuff. And I'm showing the and I think if the market will probably end down a little bit. I only give that a 50% confidence because I think it's just going to go back and forth. You know, I'm looking at the 60-minute chart for the E-mini, and I've drawn these purple lines, and right now it's just trading in a channel. And I think if that was the Santa Claus rally last week, then Santa should have hooked up Rudolph because it didn't really have any clear direction, I don't think, right? We did have an impulsive move down here, right here. I use Fibonacci retracements a lot in my analysis, but if this move up had been corrective, it should have stalled, at about 38.2 to 61.8, but it didn't. So too big to be a corrective move. So it's just stuck in this channel right now, and I think this channel will probably narrow to something like this, right, which gives us like about a 40-point channel on the S&P. And if it breaks out of that, then we may have a real direction, but I think it will probably stay in there. And so making a prediction this week is just really hard. I am biased to the downside. I'm bearish on the long term. I've got predictions on the longer term, daily, weekly charts. But the rest of this week, it's a 50-50. And I agree. I don't think it'll make a big move either way.
Okay, and since you mentioned that you have some longer term predictions, why don't you could you quickly show us? Could you flip out to maybe a weekly or daily and show us those predictions?
Yeah, let me get there. Let me pull up the Dow here. Is this sharing?
Yes.
Yeah. So on the Dow, here's on my weekly chart. I'm just looking at we've been in a 6-year bear rally, bull rally.
We're still looking at your 60-minute chart.
Yeah, let me go back to Hangouts and reshare. Okay, share. There we go. This one.
There we go.
Good now? Good now?
Yeah, good to go.
All right, so here's the Dow on a weekly chart, right? We've been in a 6-year bull run, and, using my indicators, my analysis, we're starting to see this sequence of lower lows, lower highs, which indicates a change in trend. So I'm looking at a correction down into Dow. It's 14.4 to 12.03, which is just a normal Fibonacci retracement, in an ongoing trend. So that's what I'm looking for on the Dow. That's about a 30-40% correction. Healthy, normal thing, but that's where I see it going. I'm publishing this up to my subscribers. I publish a newsletter every week, and so we're tracking that.
Okay, you cut out for a second. You said would it be like a 30% retrace or a 30% sell-off?
Really the same thing. 30 to 40% correction from the high. So again, down to about 14.4 to 12,000 on the Dow. Occurring in 2016. It's my prediction.
Yeah, I think that's plausible. I don't know the exact timing on it, but I might dovetail in on a little bit of that when it comes to me. Let's go to you, Gary Dean of sentimenttrader.com. what developing events, and if you want to share charts, feel free to do so, will you be watching this week? They can be technical or fundamental that you think will have a positive or negative influence on the markets.
Well, there's a couple things that I'm watching. Is one of them is obviously going to be the how sentiment reacts. Hang on, I'm just trying to pull up my charts here. Let me see if that's it. Okay. So really, what we're looking at is we had a 92% sentiment, but the reason why I'm saying for this week why it's going to be, I'm thinking it's going to be choppy. Can you see my screen? Is that okay?
Absolutely. Yeah.
Okay. So these are our sentiment charts, and this is what Woody comes out with. And the reason why I'm kind of unsure on what happens this week is this is an intermediate term sentiment, and this is the moving average on it. So you can see we're pretty low. There's been a lot of bearishness in this market since a drop that we saw in early December. So it typically your good time to really be looking for a pretty reliable short would be when we have intermediate term sentiment that's at highs, and we're seeing a halo of high but bullish sentiment readings. Those are when the big drops come. So we had a 0% reading that really kicked off the Santa rally, and now we're starting to get, it's not on here right now, but we had a 91% bullish reading. So there's a it could be choppy going into it, but really the thing that I'm looking at as far as why this move made sense on the downside, this is just a 15-minute chart of the S&P. So we had bearish divergences in place here, and it's burning them off. In the fact that on the 60-minute chart, we don't really have any bearish divergences. We're a little bit oversold. We're really trading within this triangle. And the way that I'm looking at it, David, is that it's just a series of ABC moves. There's nothing that's really that you can hang your hat on the big move until it breaks out of this triangle. And one thing that would really make sense to me that I've been showing people is the first move up before we had the drop in December, that was your A, B, and now we're making the wave C up. So this wave B down to the 2041 was a target I was looking for. So we could head up from there if it holds. If it doesn't, then we're probably looking down to the somewhere into the 2030 area. But what would make the most sense is that this pullback is going to be followed by a move to the upside. And it may end the week on Thursday, somewhere right around where we started it. But I can see another little push to the upside. But after that, that's when things, in my eyes, I think are going to get pretty, where everything is going to, we're going to have to see where the, where the bulls are going to try to defend. So just as far as the retracement wise, anywhere from the 2043, and honestly, we can go all the way down to the 2020, and this could still make sense. But on a longer term basis, I'm kind of agreeing with I would be very careful on it. I mean, obviously, the tough part about making longer term predictions is you just don't know. The playing field is changing every month, So
I often say all predictions are about the future, and a lot of stuff could happen between now and then.
Exactly. So if we're just following the game is going to be played fair and nothing else is going to happen. Once this is a weekly chart of the S&P, and the way that I'm looking at it, we could have made a failed fifth wave here. But we could pop higher, and it will still be it. But the problem with this is we have, some pretty big bearish divergences in place on the weekly. And once this completes, a typical retracement after 5 waves up, and this, again, started in 2009, this rally would be anywhere from a 38 to 50, 62, and even a 78% retracement, and still be considered bullish. But I meant nobody's going to be looking at this market as bullish if we go all the way down to 980 on the S&P. Yeah. So I'm not saying that is what's going to happen, but I'm just saying with the wave structure and the divergences in the longer term charts, a pullback, seeing the S&P trading down to the 15 or 1400 level would not surprise me one bit. But again, so many things could change during that time period that we may end up at 2500 before anything even makes a drop. So, but that's for this week, I really want to see how the bulls defend some of the pivot areas down here. If they do, then we could edge higher into it. It's there's not I don't have a lot of conviction on either side. I think a neutral basis is probably your best until the new year starts and people start coming back from the holidays.
Yeah, it's interesting. Dean and Dean here both say that there's a potential to be some bearish developments here. And what's amazing is you tell people that markets go up and markets go down, and they look at you like I wrote in my column a while back. Look at like you pooed your pants, like you went into Starbucks and just asked for a cup of coffee, But markets go down sometimes, and if you tell them they go down, then they get mad at you and they tell you why it should go up. But it's weird. They believe that markets go up, markets go down until you tell them that it might be going down. So that's always fascinating.
Well, the funny part about it is that when you hear the people on TV, nobody really understands that they make money when the market goes up. They really don't make money when the market goes down because they're half of them are either fund managers or brokers, so they want people to keep their money in the market, and it's one of those things you have to have an objective look to everything and just accept that it's going to go down at some point. When? We'll find out, but it should be interesting.
Gotcha. All right, Michael, to you, and I know you're looking out at probably about the next 3 to 4 seconds to 3 to 4 minutes, but anyway, if there's any developing events you're going to watch out for this week, the routine, let us know.
Well, yes. Actually, I think that there are, and I think that the 800-pound gorilla in the room, or the canary in the coal mine, continues to be interest rates. And not that we're expecting anything, until next year. But I think that as things continue to just roll out, I think we're getting a lot of mixed messages in the markets because of year-end plays. I mean, if you take a look at the metals, we've got fund managers and portfolio managers who are hugely short.
Yeah.
And that's the position they all put on, and they're going to be damned if they're going to let this thing go up before they get a chance to book it for the end of the year.
Yeah.
But I think that is a stick of dynamite that's getting lit. And I don't think it's going to be to the downside.
Yeah,
so,
fully agree.
So,
two things there. One, I think when that rally does come, I think it's going to be great. I'm watching aluminum right now, aluminum stocks. I think it's going to be fantastic. And the other thing that I think you're kind of alluding to is that we could see a massive deleveraging in this market if rates bump a little more.
Yes. A huge deleveraging, because so far I think the spin has been put out that, hey, higher interest rates are bullish for the market. I'm not sure who started that rumor, but it seems to be taking hold.
Yeah.
Now, I just want to go back and I want to comment just one thing on the Elliott wave count that Dean presented. And while I don't consider we may well be in the fifth wave going up, but I think in terms of if you're going to really fill out that picture, you've got to bump it up several degrees and realize it's a fifth of what? And to me, it's a fifth of a fifth of a fifth. So this is it. When it hits that high and it goes and makes new highs and we're getting confirmation that it's over, I'm not going to be worried about that it's going to retrace 38%, 50%, or 62%. I think it gives up the ghost and may take a lot longer. But I think that people need to be better prepared and for what truly lies ahead and what the Elliott wave count is actually telling us. And I don't mean to step on any toes here, but I've been an Elliott analyst for over 30 years, and what I've always found is that I've tried to encourage people, start with the biggest picture you can get.
Amen.
And then work your way down and work your way down. And I can really bring that down all the way to a tick chart. And you can use it on a tick chart and still have reliable, waves that you can count and trade off of. But another thing that I'm looking at for year end is that, again, we've got this rally that I don't think enough people are out yet, and I think if they continue to pound the metals, that's going to bring in some of the buyers back into equities. But you've got a lot of the media talking about, well, crude prices are lower, and that's going to pull down the equity markets. For whatever reason, that's what they want to say. And I don't think that's done. I think that crude will end up below 30 bucks before all is said and done. And if that really happens and they want to keep that link going, I think that could pull the market in a very negative way as well. But on an Elliott wave basis, just to piggyback on what Dean was mentioning, I actually think we're still in wave 4. I don't think wave 4 is done. So I think it's probably going to come down, produce maybe a slight new low below, and then rally to new highs next year.
Two Elliott guys not agreeing. I've never seen that before.
You know what? I would just to touch it real quick. I mean, on the longer term view, I think I mentioned it before. It's something to look at. It's not something I would ever put a lot of money on, just because of, like we said, there's so many different counts, and half the people don't even know where we are and what it is. Yeah, so I just use it as, if it does drop hard, okay, pay attention, because it would make sense. And whether we're in a 4 or 5, I mean, I'm more in a, what's going to happen from now into 1 month or 2 months, and
right.
So the bigger picture, that was just showing, hey, if it does drop, it would make sense. We could be in a 4. We could. It doesn't. I wouldn't even be saying that that's wrong. It could very well could be. I focus more on the Elliott wave on a 60-minute, because it gives you a good trade setup that can do a lot of points. And looking for the big bear market to start. Hey, if it happens, it happens. That's really the way that I'm looking at it.
Yeah, one thing that I found, I'm not a big fan of Elliott, but I found that everything works better than with trend. So the Elliott people I've met who are following the trend also tend to do very well. The Elliott people that I met, where it's been a top for the last 35 years, they get it right about once every 15 years, and that's I'm not sure you can trade off of that. So that's kind of my beef with the Elliott guys. But it just seems like those who put a little trend filter in there, they don't get so caught up that it's always a top,
Right.
Anyway, I'm not trying to stir the pot, so sorry. All right, AJ. Look, AJ went to take a leak, but he looks like he came back quickly. You're up, AJ.
Hey there. All right, I'm going to share my screen here. Listen, I follow all of these different, if you will, theories, but at the same time, thankfully, since I'm doing the equity options and the equities, I have this tool chest that allows me to profit no matter what the market comes my way, right? So I'm taking a lot of looks at the VIX compared to the S&P 500, and I'm watching the daily put-call ratio that's being published, and deciding what to do based on, what patterns are coming my way. And I'm actually working with my folks and really emphasizing the importance of not only IDing the pattern, but then coming up with the validation tests outside of the identification of that pattern that would give you a confidence. What's your confidence? Just like you asked us, I say, what's your confidence 0 to 10? And the combination of the confidence of that pattern with the pattern that's ID'd then dictates for us which option strategy we're going to use. Because if we ID a pattern and we have a 9 confidence versus a 3 confidence, we'd pick 2 different patterns, right? So with that said, quadruple witching just passed, and not just, but before the holiday. And so we're all focusing here at Trading Trainer on setting up our monthly theta decay positions, right?
Mm-hmm.
And that's taking advantage of the chop that's going down and the low volume, putting a lot of if you will, low confidence on the directional patterns. The other thing we're looking at is those stocks that have repeatable volatility rushes as we get close to next month's earnings session. So we're looking at where we could take advantage of an increase in volatility as people start to get excited for the next earnings release. And so that's really what we're focusing on. Again, understanding fully that right now the price action that's happening is tradable if you want to go in on the short duration, but in the meantime, the minute the volume comes back, it could change on a dime.
Mm-hmm.
So that's where we're at.
All right, cool. I don't know if I answered the up or down, and hopefully, if I did, I'm not going to change my mind already. But I'm going to go with down and a confidence of 60%. It probably should be less than that, but I'm going to just kind of stick with something that has a bit of a positive bias to the downside. And the reason I'm going to stick with that for now is that back in September, we had September. We had a weekly bow tie down. This is just a simple little pattern that I created and follow, and this is just where a 10-day simple, a 20-day exponential, and a 30-day exponential come together quickly over a short period of time, and then began to diverge out. I also like to put a 50-day in there to see how strong that change of cycles is into the longer-term average of the market. Anyway. It obviously hasn't really materialized much from then, but it hasn't made a new top either. And, you know, I mean, like I said a minute ago, I'm not a big fan of Elliott, but I was looking at, I think it was Dean's charts, Dean Jenkins charts, where he was showing that looked like kind of a double top in here. And no matter what your technical analysis is, a lot of times they all sort of dovetail in or they're in agreement. And my point is that until we make new highs, or I probably should say unless we make new highs on the S&P 500, this weekly sell signal remains intact. And as I've said in quite a few other shows, we had one in 2000 on the sell side. 2000 on the sell side, and then right here in 2007, early 2008 on the sell side. And then we had major buy signals in 03 and 09. So there's a little lag to this, but sometimes lag is a good thing because it doesn't always unfold over a day or two. And I think that right now I'm going to stay bearish until the market makes new highs. Doesn't mean that I'll completely ignore the long side. We're taking a look at one long right now. We've got a couple of shorts in the portfolio and looking to add an additional short right now. But other than that, we're not taking a whole lot of action because, as I wrote today's column, you look at what we've done for 2015, and we haven't done a whole lot. You can see we're going mostly sideways, and then if we stay weak today, we'll probably be, I would think we'd see a little bit more follow-through and be weak for the year. If you take a look at the Russell 2000, stick a fork in it, I think it's done. It sort of looks like a big picture top that you would see in something like an Edwards and McGee or Schaubacher, one of those classical books on technical analysis. When you look at the weekly, it's a little bit more cleaner. It kind of looks like an inverted cup and handle. Also, you can go back to 2013. So if you didn't know anything about reading charts, you could say, well, where's the market today? This is the Russell 2000 IWM. And where was the market, back in 2013? You can see we're actually kind of negative. Depends on where you, what spot you pick. So, and then also, again, you have that weekly signal working. And it hasn't really retraced back up that much, especially when you're comparing how much it's retraced to the P. So I think the Russell, being a broad-based index, is I don't know if the word's a harbinger of things to come, but it doesn't look good. So if this Russell went on to make new highs, I'd start feeling a little bit better about the overall market. But for now, I think we need to stay cautious. Again, it doesn't mean I'm going to totally ignore the long side. If I see a great-looking setup, I'm going to take it. But for the most part, I think you might want to err on the short side, or maybe even err on not doing much. Because as a trend follower, when the big blue arrow is pointing sideways like this, there's not a whole lot of action that should be taken. So either stay flat or maybe look to nibble a little bit on the short side in anticipation of possibly some additional weakness in here. Okay, let's go back to Gary Dean. And the question this week is, have you had the most success with fully automated trading systems or trading systems that are at least partially discretionary?
I don't automated trading. We're not really into the discretionary. Was definitely more into it, but again, we're a lot of the stuff that we do is it's changing on a especially now with the I haven't seen these sentiment readings jumping from extreme bearish to extreme bullish so fast, and I was talking this over with Woody, and he said it's a rare occurrence that's happening right now, and it's one of those things that it's everyone believes that they're missing. So many people believe that we're about to start this big down move, that they're jumping onto the bearish bandwagon, and the minute that it's getting extreme, we're getting 0% bullish readings, the market's screaming higher, everyone gets forced to cover, then they start jumping on this bandwagon on the upside, and we get a 98% bullish reading.
Yeah.
And the minute they're all in there, it goes right back down again. And sentiment's not just because it's high or low, it means it's a buy or sell signal. But lately, it has, and it's been crazy where, there's times I don't use a single technical indicator. I'm just, as soon as I start seeing that everybody's jumping on one side, I'm just looking at, okay, where's the resistance or where's support to be able to look to buy and try not, obviously I do look at other indicators just to see if there's divergences in place, but I'm definitely, we're not on the automated end of things. I don't, the trades that I look at are, really based off of, I may be slightly bearish now, and if we dropped 200, 300 points on the Dow and sentiment went down to 1%, I could be bullish the next day just because that's the way this market's been moving. It's been just catching everybody on the wrong side as much as possible, and it's one of those crazier things that we, some of the things that we have not ever seen before, where people are going from extreme bullish to bearish in a week 3 different times. And
wow.
Normally, you don't get those kind of shifts in sentiment, and it's been extremely it's been profitable to be able to trade it, because the way that I've explained to a lot of people, Dave, it's like playing Texas Hold'em and being able to look at the people you're playing against, their cards, because you're knowing what everyone is feeling, and you're seeing it through this data. And it's you simply that's where I put in a lot of the Elliott wave stuff on a shorter term basis, because I'm like, all right, we know everybody's bullish on the market. What is the wave count showing? Is there divergences? And then just try to pick and choose where where you want to start layering in a position.
When you're getting a sentiment reading, how is that a survey that gets taken, asking everybody?
He's been doing this the same sentiment data. He's actually one of only 2 people in the world that do it. He's been doing this. It's a list of, it could be brokerage firms, it could be, there's some insurance. It's about 200 people that do this survey every single day, but they're basing it off of their clients as well. So there's these 200 people that are putting in their bullish or bearish readings. It actually is almost giving the sentiment for 20, 30,000 people, just because of they're giving us their sentiment based off of what their clients are telling them. So it ends up being 200 people, but it's tens of thousands of people that it's actually relaying the sentiment of them, and that's why one of the things that Woody wrote in his book about behavioral trading is the important piece about tracking sentiment is you have to get it from the same people. And a lot of these the sites that have free sentiment stuff out there, you just don't know who's putting it in, who's putting this information in, and if you don't know that, you're not going to get the real readings. But he's one of the only people in the world that's been doing the same sentiment reading for over 30 years, and he's become the master in it. And
that makes a little more sense to me, because one thing that I think you sort of pointed out is that where's the sentiment, whose sentiment. So that sounds a little bit more plausible. My problem with sentiment seems to be that everybody's going to be bullish while the market's at new highs, but in order for the market to keep going higher, it's going to keep having to make new highs. But I could see that if you're factoring another indicator into that and not trading purely off of sentiment and maybe looking for the turning point. I hear you on that.
Can I show you something real quick?
Sure,
It's an interesting piece because what you said was. Can you see my screen? I'm not sure if I hit the right thing. Let me.
We see your face, but your mouth is not moving.
All right, yeah, that's just a picture. Okay, so it's showing now, right? All right, you have it now, right? You're showing it. So when you were saying with the sentiment, where it's at new highs where we get it, this was when we got that big drop that took place in August, which it made sense. We had so many different. We had a series of bullish sentiments when we weren't at the new highs, and that's another thing that I had mentioned to Woody about, was because when we were getting 90%, 98% bullish readings, and we weren't anywhere near the previous highs. And he said it's definitely something is changing in this market, and he's like, people are trying to catch more of the move, but we haven't been at new highs, and we're still getting these massive bullish readings, and then we get the big drop, and they're switching from extreme bullish to extreme bearish in a day, and it's kind of crazy with it. So I thought that was interesting, because you said a lot of the bullish sentiment is after we make new highs, and with this it's these people are switching back and forth very, very quickly. So, but that is true. Most of the time, you did get the high sentiment readings was when we were making new highs, and from there it was, if you got a series of them, that was your big warning sign about the market's going to turn. So I'm sorry, I didn't mean to hog everything on.
No, that's okay. No, it's my fault too for digging deeper into this. No, I appreciate that. I kind of like what you showed. You're kind of pointing out that everyone seems to be fighting it out, and with the market going mostly sideways for the year, as the rest of you guys have sort of begun to point out, we could see a big move one way or the other, because traders don't agree for long. But
Yep.
It sounds like there's that big move right now seems like the obvious direction would be the downside. But
I think so. I agree with you on that.
We'll have to wait and see. And I think everybody else here agrees that you can't predict too far out. All right, Michael, we hadn't forgotten about you. I forgot the question. Oh, I think I can answer for you. Have you had the most success with fully automated trading systems or trading systems that are at least partially discretionary?
That actually is a tough question to answer, because it's kind of depends on the day. But I would say fully automated with partial discretion, that I can go in and I can do what I want to do, while it's already doing what it needs to do. So I would say fully automated with partial discretion. So I can go in and
I kind of like that answer, because I'm kind of an anti-mechanical guy, which I'll get to when I get to my when I get to the question, when I answer the question. But what's interesting is the mechanical guys I know that seem to do the best are those who have a little layer of discretion on there, and like one guy in particular, if the market is just kind of in a roaring uptrend, he's getting sell signals, he just sticks on the side of the trend and tends to do a lot better than those people who are purely mechanical. So that's an interesting answer. AJ, let's go to you. Have you had the most success with fully automated trading systems or trading systems that are at least partially discretionary?
So the way that I pull it together is, and I've actually just hammered last night on a webinar to my group, is that in the times of rest, meaning outside of the trading session, you need to be putting together your plan for the next trading session. And you need to visit your plan for your new positions and your open positions in between each trading session. Get your plan written down and then do your plan. And when I do, I'm going to share my screen just for a quick moment here. When you do your plan, so this is the little member area that I set up for my folks here. We actually have an area where you can actually log in and put in your plans, and it'll watch it for you in real time, send you an email or a text message to go look at that when the plan gets met. And that's the way I've been trading for over 15 years now, where I get my emails so that I don't have to have the charts open during the day. I'll pre-queue up my trades with my broker, and when I get one of these buzzes on my mobile phone, I'll spend about 4 or 5 minutes looking and making that final decision before I execute the pre-queued trade. And just like you said, if it's not going along with what the rest of the market's doing, I won't pull the trigger. If it doesn't pass my tests, my quick tests, but I'm not going to put too much emotion. I'm going to follow that plan that I did and put together the evening before. So that's my whole process. So yeah, I don't do anything fully automated, but I do use tools during the day so I don't have to be sitting in front of the machine nonstop.
We could just have Michael do it for you. He's sitting
Oh,
there.
you know what? I didn't. Was I even sharing my screen? No, I don't think I was.
No, it did come. It did come through for.
Here it
the
is,
whole
just
thing.
really quick. This is my advanced alert system, so I apologize. I keep thinking I'm sharing my screen, and I'm not sharing anything. But here it is, the little system that we set up our little trades. It looks for whatever setups we wanted to put in our plan, and it'll send us a little text message if it's time to pull something up during the day, and otherwise we don't have to get caught up in the bells and the whistles of the day.
Who's that young clean cut guy on top of that site?
Ah, he goes away at Christmas time when I just stay in my house.
Okay.
All right. Thank you.
All right, D. Jenkins, same question to you. Have you had the most success with fully automated trading systems or trading systems that are least partially discretionary?
Yeah, I liked AJ's answer, and it made me think that maybe I'm partially automated because I use alerts, but I certainly don't use a mechanical system at all. I'm not a good enough programmer. I've tried to do that in the past, and I could program some trading ideas and optimize them for pretty much any period in history, but I could never make them work going forward. So I trade exclusively discretionary, but I do use alerts and I think just what AJ was saying. My trading rules are almost mechanical. I liked the discussion earlier about Elliott Wave, made me smile. And that's because I think I like the flexibility of Elliott Wave analysis, and even the fact that even on the same time frame, if you have a big impulsive wave, there can be 5 wave sequences within that, and there's fractal symmetry where at any level of magnification, you can find these patterns present, and when you see a clear pattern, there's just a really high probability. I'm showing a trade here. This is a Goldman Sachs, and I'm just showing, according to my analysis, right, we got a wave 1 down, wave 2 up, a big impulsive 3 down, a perfect 4 correction into the Fibonacci zone up to 61.8, and now I'm projecting a wave 5 down here into a Fibonacci extension area. And we're short this at this cyan line, got a stop here at this red line, and a target zone, 170 to 150. And when I see a super clear pattern, I go into it. I've got these very ironclad rules. I never go in without a stop, without a target, and without a strategy to manage the trade about where I'm going to scale off, take profit, how I'm going to move my stops, how I'm going to exit. And that's almost automated, but there's no software doing it. It's just a predetermined, pre-programmed set of steps to take once I'm in a trade.
Yeah, like I said before, I think it's a bad idea to be purely mechanical. I think it's good to have a little discretion on top of that. Hang on 1 second.
Yeah.
Dean, I have to catch up with you later. We have a lot of similarities.
Is that AJ talking?
Yeah.
Yeah. Yeah, it'd be cool to talk to you. It would.
For sure.
It would. But I liked, your comments made me think, you could almost call me an automated trader because I don't get into a trade without, black and white criteria being met.
Absolutely.
And I manage a trade with black and white criteria. There's no emotion. There's a set of rules that are followed.
Absolutely.
Right? You could probably program that, right? Yeah. But the discretion is, there's an art to analyzing the waves and seeing whether it meets your rules and stuff like that. But
right.
Yeah.
Yeah.
A little uncomfortable letting the computer do my entries for me. If I could program it, I think I'd still want a yes, I agree button.
Yeah, no, I agree with that. Sorry with that. I had a courier, and I put in a brand new window a brand new door where I could see straight out of it, but she was hiding behind it. So it's like, Anyway, I also have an on-air side outside that I forgot to plug in, so I guess it doesn't work if you don't use it. I agree with some of the things that were said. I used to spend years and years programming mechanical systems. I have a degree in computer science, and I figured that I might as well use it. Then, one day I went to the house to tell my wife about my latest discovery, and she said, "How many trading systems do you really need?" And it made me realize, hey, the one you're going to follow is the one that you should, is the one you need. So you just need one trading system. I think the problem with mechanical trading systems is you're curve fitting to past data. Your biggest drawdowns are usually often in front of you, and there's a lot of hindsight involved. And you're recognizing an aberration in the markets. If you're like this year, I think a mean reversion system would have printed money, but if you look at hindsight, we had a choppy market all year. So the people who are selling naked options on the outside and doing crazy, naked spreads or whatever, probably were rewarded very nicely. But that'll work until it don't. I see AJ laughing over there. What's kind of interesting is I do like what one of the deans was saying. I got a little mixed up when the courier came in, but I like that you said that you take trades almost mechanically when you see them, but it's not like you're letting the computer do all the work for you and actually place a trade for you. I have a friend who's a mechanical trader, and it's kind of interesting. He's successful at what he does, and I think he's more discretionary than he lets on to, and that he thinks I'm a lot more mechanical than I admit to. And I think that there could be a little bit of both. When I see a certain bow tie set up or one of my other patterns in a market that I really like, my execution becomes almost mechanical, kind of like what AJ was saying with the trade your plan. Plan your trade and then trade your plan. Plan your trade, trade your plan. So I guess I'm not 100% anti-mechanical, but I think you got to be really careful that you're not just recognizing some sort of aberration. And I think that what everyone here has alluded to is that we all have a brain in our heads. We might as well use it. And that's why I'm sort of, if you had to rate me as mechanical, anti-mechanical, or anti-mechanical, I'm kind of against pure mechanical trading. But I think that once you recognize certain market conditions, your execution needs to be almost mechanically in how you do it. But as far as mechanical versus discretionary, I would consider myself a 100% discretionary trading, but maybe some of my execution, you could argue, is a little bit more mechanical.
Makes me think
of great show this week. If I think I should, if I say so myself, but good lineup, and I learned a lot, and I've got a lot of notes to follow up on. So I want to thank all you guys for being here. I'm going to let David close the show up just because we're out of time. But thank you guys for showing up. And again, it was a great show. I really enjoyed today. Thank you so much.
Thank you.
All right, thanks, guys. Great show. I want to remind everyone to go to TimingResearch.com/reports, and you can download this or any past report there. There's always some info in the reports that we don't get to talk about on the show, so be sure to check that out. Also, go to TimingResearch.com/current survey next weekend and fill out the survey and be part of the data for the next report on Sunday. So I just want to thank all my guests: Gary Dean of SentimentTiming.com, Michael Filighera of LogicalSignals.com, AJ Brown of TradingTrainer.com, Dean Jenkins of FollowMeTrades.com, and of course Dave Landry of DaveLandry.com. Thanks for hosting again.
Thank you.
All right.
Thank you.
Thanks, guys.
Thanks, everybody. Take care.
All right, thanks.